run around the room. For those of you who don't know, I'm Richard Hall. I head up Polestar along with Charlie. Charlie's, as I think mentioned to most of you, he's unfortunately not able to be with us today. He had an operation that was pushed back a couple of weeks, so he's still recuperating from that. Then going around the room, we've got Richard Shaw from Growth Capital Partners. Then Marshall King, who's done a number of different things in a serial entrepreneur, I think, on the tech side. We have Barry Ann's joining us remotely later on with Education Horizon Group, and Vicky down the end there, touch on some of the legal aspects. So we'll each of those will do a brief presentation to run through, and we'll have a Q&A session at the end to hopefully get the benefit of the different people's knowledge around the room, and online. Before we sort of go into the detail, thought worth touching on really some deal execution drivers as we see them, and the first one of those to sort of run down is timing. And we're definitely in a dynamic market. It's very positive, although the spike of the COVID period has obviously sort of dropped off. It's still an attractive sector to be in, and actually because of the sticky nature of the market, you are finding that it's a really good place to be doing acquisitions as people want to expand their footprint and make sure that they build the scale in a shorter period of time as possible. But time's a sort of two-way street. It's sort of positioning your business at the right point for exit of yours, and equally looking at the timing from the point of view of the buyer. And the buyer elements, aside from the market spike there that you might get, we had a business that we knew of in the States that came to us, and they were looking for a specific acquisition to fill in a skill set that they didn't have within their portfolio, and that element of it pushed the price to nearly twice what the guy was expecting to sell it for. So we went away and found a party. He didn't actually sell it at the peak of the market, and he's now looking to sell it now. And as you can see, the timing may not be quite so right, although he has actually grown in the meantime. But I suspect we'll be hard pushed to get the same actual cash valuation out of it. So timing is really, really important in terms of coming to the market. And that ties in with the current market into sort of competitive tension. So we want to keep people honest and motivated to do a transaction, and just make sure that the bidders are in a good place to do a transaction, and really the FOMO, the fear of missing out, both from the point of view of the opportunity that your business presents, but actually critically from the point of view of a defensive standpoint. So we had a business a few years back, and we actually went out to only two parties because neither of those parties could afford for the other one to have it, and we had a 50% premium over the valuation that the guys were expecting for their business, and what the multiple said it was, simply because there were two players that were very similar in the market. And this was the number 4 in the market. They didn't want us to talk to the number 1 because they were a bit competitive with them. But we basically played number 2 and number 3 off against each other, and the price just carried on going up. So, and that we're seeing more and more of that as people try to expand their portfolio of skills and expertise to make sure that other people can't attack their client base. That's key on timing. And then I thought I'd just touch on two things that perhaps less talked about when we talk about value, and that's confidence and perspective. So throughout a process, whether it's for getting external investment or for an exit, What we're trying to do is give the buyers confidence in the future opportunity presented by your business and how that's going to develop over time and fit in with their business. There's always going to be a fear of the unknown. You've got to remember that the buyer never knows as much about the business as you do. You know, you've been sitting in it, you understand it, you understand that, you know, this problem over here, it's not really a problem because I've got all the backstory and history to it, but actually need to present that and get people comfortable with that position. Of course, you need evidence. So the metrics that I know our different panel members are going to canter through it shortly. That does form the basis of the valuation, the metrics there. But it's important that we maintain that confidence flow through a process and keep up momentum. And to that, the one thing that can detract from that momentum and that snowball effect, if you like, is if you lose trust. So again, we want to be thinking about any problems in advance so that we can issue the narrative around it and run through it and present it as how we want to, and not have them find it at a later stage. That's not a good scenario. That then brings me on to perspective. So really what we're talking about here is standing in the other party's shoes. And I say parties advisably, because within the buyer side, there's going to be more than one person. And even if there's one individual that is actually the decision maker at the end of the day, we need to pay attention to the perspectives of people around that around the table, because they'll all come with different experiences, different issues that they want to address. So we need to try and make sure that when they go back and have a discussion in their own offices, that influences and any concerns are covered off. So with that, what I'm going to do is we've got a good panel around here of people with different experience and different perspectives. So we're going to get them talking, and then we'll crack on from there. So I'll pass on to Marshall.
Richard, thank you very much for that introduction. I'm going to spend 5 or 10 minutes just, I guess, talking about the same topic, but coming from the perspective perhaps of an entrepreneur or maybe a management consultant, those being my two primary experiences. Topic is maximising the value of a business. I would say at the outset that any ideal sales process starts several years before you actually get to engage someone with the expertise of Polestar. And I think the most important thing to remember is that any acquirer is looking to make a return on the money they put down on your business. So your point about standing in their shoes, very accurate in my view. How you've got to be thinking about how can the eventual acquirer of this business make more money than you make or you are making in the business. So that's kind of the thing I think to think about, and the task is really to prove that both to yourself and to them, and have the data at your fingertips to do that.
Yeah.
There we go. So just a couple of minutes about me. I started my career at Bain & Company, management consultancy, very data-driven type of organization, and that sort of data approach, I guess, has never left me. Dun & Bradstreet was my first subscription data business. I did various sales and marketing roles there, and then I did a startup in the heady years of the sort of 2000 .com explosion and subsequent bust. And in terms of business model, I would say I pretty much tried every single business model in that. But finally settled on a kind of outsourcing multi-year contract business, which we then sold to HomeServe, a property maintenance company. I went on to be the CEO for recurring revenue model VC-backed businesses, insurance broking, property data, and more laterally pure SaaS-based businesses. So quite a bit of experience in what I call the recurring revenue model approach. And in the most recent years, I've been a consultant or a non-executive for mainly small SaaS or recurring revenue model businesses. Why do acquirers like recurring revenue model businesses? Obviously, high gross margins is one of the key things, because as you grow the revenue, you don't grow the cost base so much, and all that lovely profit drops to the bottom line. And that's, kind of obvious, but just stating that up front, that's kind of one of the goals. It's SaaS. It's how do you get your gross margins up, and how do you prove that they can be sustained as the business grows. And also on the downside, actually, in a recurring revenue model business, when you acquire that, if something goes wrong or someone important walks out or a key salesperson leaves, you've got some time to fix it, because it has some momentum it runs. It's not like a consultancy business that might just walk out the door with the key people. So those are two things to bear in mind as you build your business models, that they're highly, the quality of revenues, as people term it, is much higher in those types of situations. But when I come to analyze a business in the recurring revenue kind of business model, what I like to look at is something we call unit economics. And really what that boils down to is how much is each customer worth compared to how much it costs to acquire each customer. And particularly with these high gross margin businesses, that becomes the key metric, because that is the lever that enables the buyer to turn it into a money-making machine, which of course allows you to put your price up. So how do we assess unit economics? So we typically talk about lifetime value of a customer, and that's, in a very simple terms, a simple calculation. It's the annual gross margin of that customer multiplied by the number of years that they remain a customer. And we like to compare that with the customer acquisition cost, or CAC as it's termed, which is, in simple terms, the total of your sales and marketing expense divided by the number of customers that you acquire in the period. Say it's a year of sales and marketing, how many customers did you acquire? Therefore, what's the average customer acquisition cost? And if you do the ratio of those two, if that turns out to be a high number, high single digits, or God willing double digits, then you're into a proper money-making machine. And what that means is the acquirer can just invest to win more customers, knowing that they're going to get 5 times or 7 times or 10 times as much money out the back of the machine eventually. And in one of the goals, I think, for the seller is to prove that the acquirer. So build the data and history in the business that enables you to actually show that. So very simply, if you were to do the calc here, it's, say you have a business with an annual subscription of 2,400 per year, 70% gross margin, and clients stay 5 years, then you multiply that out, you get 8,400 as lifetime value on average per customer. So you spend $1 million on sales and marketing, and you get 500 new clients a year. That's $1 million divided by 500, £2,000. Your LTV to CAC is then 4.2. 4.2 is actually not bad. Anything under 3 is generally considered unsustainable as a recurring revenue model business. Anything over 6 is generally considered quite good. And as I say, upwards of that, you're into very valuable business territory. Correct me if I'm wrong, but that's certainly my experience. But the interesting thing when you do this is that it reveals a whole pile of strategic issues in the business. This is where I think, as a consultant or as a CEO of a business, it gets really interesting. Because if you explore the business in terms of this ratio, then you think about, how do I increase lifetime value, or how do I reduce customer acquisition cost? So on lifetime value, obviously you can increase your prices, you can upsell or cross-sell more, or you can lower your churn, customers longer. Those are very obvious things, but when you think about your own businesses, of course, there are loads of little tiny things you can do You know, should you give discounts for a longer lifetime? Should you take out that middle level of pricing and just put in a top level to boost some people up, et cetera, et cetera. So lots of strategic issues fall out of lifetime value. And equally on customer acquisition cost, what about marketing sales efficiency? Should you focus down on a niche that's easier to sell to? Should you work on customer referrals that are cheaper? What about sales skills and being more effective? What about cost of sale, customization costs, charging for implementation? I mean, there's 100 questions that come out of this type of analysis. And in terms of process, the first thing you've got to do is get some kind of measure around it. So it's not easy, but you've got to start somewhere, and certainly at a whole business level, it's probably not too difficult. What that always, almost in my experience, reveals is that you need to segment down your business into different groups of customers or different markets, and then try and do that LTV to CAC calculation at that segment level. And what you often find, and I've literally just finished a project that you know, the same thing turned out. You've got to adapt your go-to-market motions and your customer acquisition approach and your service approach and your lifetime value approach to those different segments. Yeah, we had an experience recently where the business was 4,000 customers. They found that they were serving them all in the same way. 2,000 of them, you know, were definitely unprofitable the way they were going to market and needed to be transitioned to a self-serve software model with a offshore servicing arm. And the top 50 customers needed a completely customized approach with more high-level sort of software sales engineers that could really develop those relationships. So that LTV to CAC analysis can go pretty much a long way, I feel. And what that allows you to do ultimately is build clarity on your profitable customer segments, maybe ditch the ones that don't feel profitable, double down on the ones that are good, and ultimately have that proof so that when you come to sell the business, you know, you can show that dashboard and make the acquirer feel comfortable. Of course, if you don't have this wonderful two people bidding, they want to take your business off the market, that's even better. So anyway, talked long enough. The message I leave you with is prove to your buyer that your unit economics work. You know, recurring revenue model business, then the sale value will take care of itself.
Are there any questions anybody wants to fire specifically, or would you rather we can loop round at the end, but we can do both. So
I've just got one in considering the lifetime value. How do you think about new product development? Do you think of that as a new business which is going to be resold to customers, or do you think of it as part of the lifetime of the value?
Well, I think it depends on what it is, but I would first of all think of it probably as cross-sell into the existing client base. Most product developments are, unless it's a completely new segment, in which case then you're looking at your the revenue part of the lifetime value. Maybe it's increasing the revenue per customer. You've got the cost of that product. Yeah, you've got cost as well, so you're looking at the gross margin of that. And you know, it's the GM that you put in the lifetime value calculation, not the development cost. Yeah, but I think you would probably make some allowance for the fact that you're investing in developing that new product. So you know, you can't hit it with the whole cost perhaps of that product development, but you know, you would think about eventually what would I get to with this new product? Okay.
Is there a standard formula for lifetime value? And given that you know the ones you've lost, but the ones you've still got, you think you're going to keep the first one?
Well, the lifetime is one over the churn rate. So the problem is in measuring churn is it's a lagging indicator. So you don't know the churn till it churns. So if you've got a 5-year lifetime, you know, you only know the other 5 years which one churns. So you just have to use the churn formulas and try and estimate what it's at based on history. It's not a perfect science, but that's
and trend. Like if it's getting worse, buyers are going to not have so much confidence. If it's getting better, really, you're going in the right direction.
I think it's probably fair to say that it's a really good kind of methodology in terms of looking at some comparable metrics, but then people like us tend to triangulate with the metrics as well. So you look at net revenue retention for the cross-sell and upsell piece, triangulate around to EBITDA, cash generation now as well. That's where the product development sort of side of it comes into it, and churn as a standalone sort of measure. So absolutely agree with all of this, and it's a great way of being able to benchmark and see if the underlying metrics are right, particularly in a market where sometimes people are favouring growth over profit, for example. But actually triangulating around some of those other points to answer both of your questions there, we ask ourselves the same thing quite a lot and go, right, what are the other data points? And the beauty of these kind of business models is there should be a lot of data available if you're prepared in the right way for an investor type conversation to help you, triangulate the points.
And one of the bits of data you can get is a thing called retention by cohort. And Stripe will just churn that out straight for you, which shows basically over time what your retention is. So you can see that trending up and down, essentially give you a pretty good.
Someone's got the finger on the metrics.
I had a guy show me, I was like, what? Oh, it takes a while to understand that chart, but once you do it.
Okay, so I'll just start off with the sales pitch in another 2 minutes and the background. So I'm Richard Shaw. I'm a partner at GCP. I've spent the last 22 years working with growth companies, founder-backed businesses in the UK and Ireland predominantly, B2B tech and services business models. My role at GCP is I've led our technology sector for the last 13 years. I also now lead our investment team overall. And so I've been involved in a number of businesses going either on the journey from consulting into kind of repeat and recurring kind of revenue models or your SaaS businesses as well. For this session, basically going to touch on a few points. So it's to kind of add to the conversation about specific metrics, but also to probably the point that both of you discussed around what is the buyer expected to see, what are they going to place value on? And ultimately our model is around partnering with founder and entrepreneurs and helping to build sustainable, scalable platforms. So there's a number of factors around, the financial metrics or the commercial metrics that people will look at to say, look, do I believe that this business has strategic value, for further down the line? And how can you build some of that sort of wider infrastructure and wider value creation, I suppose, in terms of the period that we get involved in. Just as an organisation, we've been going for 25 years. We've raised 5 funds. We're typically pretty flexible, to be honest. It's in terms of the deal, so we can often be a minority partner or a majority. It's all down to the existing shareholder situation. We get involved in businesses valued anywhere between 25 and 150 million, which tends to mean typically, your majority owned still by founders, or founders kind of are still on the journey of scaling. So I like to describe it as the teenage years of a business. So got some proven market position, some good customers, a good product or service, but probably still quite a lot to do to move it into how do we make it scalable, how do we make this repeatable, how do we bring in extra bandwidth and leadership for the founders to enable it to really sort of scale to the next level, and ultimately to either open it up to international larger investors or ultimately a trade exit if that's what people want to do. What that means in practice is probably 5 million ARR for a software business at the smaller end. This more services led 8 to 10 million as a start point, and profitable or certainly moving into profitability through our period of investment. So it's been nice that the market's kind of moved towards that for us over the last few years. I won't touch too heavily on this, but the reason I'm outlining it is it's absolutely key in our minds that when we're setting up a new deal, we're building a relationship with the team, alignment's absolutely key. So we're not looking to get involved in situations where people are looking for operational input or they don't understand their own market. They're experts in what they do. They've got a great business they built from the outset. People in this room will have done the same thing and built an organization. We're trying to come in with being a trusted partner to then say, well, what can we bring? You know, we can bring 25 years of experience of helping similar businesses go on the journey. If we can get aligned up front with some of the things you might have to put in place to help build the best version of the business over the next few years, that's what we're all about, really. And ultimately, it's about being agile, being able to pivot, because the business is typically moving pretty rapidly, being straightforward to deal with and being focused on people, because at the end of the day, whether it's software or services, ultimately it's intellectual capital led businesses. It's all about keep people in there and being aligned on what you're trying to build. When we found of it anyway, for the last 25 years. We get involved in software and services. So we like to think about it as the knowledge economy, clever people doing clever things, intellectual capital at the core. Actually, you know, the great thing has been over the last 5 years in particular, maybe a bit longer, we've seen a blurring of the lines. You call it tech-enabled services or service and you know, professional services models, finding out that they can productize a solution and turn it into something that's more repeatable. So we've helped numerous businesses on that journey, from kind of outsourced professional services, GRC, and moving into some of the technology subsectors that you can see on the screen there, all the way through into, you know, dedicated enterprise SaaS businesses. And this is the main bit that I wanted to kind of touch on as part of the session, basically. So what we've done over the years is try to refine an approach and say, look, what have we seen work time and again in those subsectors to help people create strategic value, shareholder value in particular. Some of this is demonstrated through a number of, you know, financial metrics, and I completely echo what everybody said about building the right data set from the start, thinking about the end goal, and making sure that you've got the right advisors on board and to help with preparation for a process, because due diligence and the amount of data is only going one way, and people are kind of increasingly wanting proof points, particularly in the current market. But actually, for the phase that I mentioned, the teenage years, what's really important is kind of going, look, you're hopefully in a great market, you've hopefully got a great product, you've hopefully got a good team around you, and you're going in the right direction. There's almost too much to do. So how do you kind of focus down on what are the key levers that can really create value in that time frame? And we've basically put together what we call a toolkit. The reason we call it a toolkit is there's no one size fits all approach, tailored to each business and situation, and different businesses will be at different stages of maturity. But we've tried to boil that down into, you know, 4 main areas really of things to think about when you're thinking about creating value. So just touch through them in order. I won't read everything on the slide here, but strategic clarity is the big one. I think one of the biggest things that bringing an investor on board like us does is it helps put a time box around something. It says, actually, you know, let's come up with what a 5-year plan could be. What could we build in that time frame? What shape of organization could this be? Now, what happens if we invested heavily in the first year or 18 months? Could we do it in 3? Then actually, if you boil that down then into what does that mean? You know, what's the ideal shape of the business, the next event, whatever that looks like? What could that look like in terms of product or service offering? What could it look like in terms of international reach? What could it look like in terms of some of the metrics we talked about here? You know, and therefore, what's the roadmap then? We tend to break that down into a kind of quarterly cadence of what are the things over and above the BAU performance in the business that you might want to put in place to help transform the organization, basically. So it starts with this clear definition, starts with getting aligned with what are the things that can really move the needle, and then coming up with a real kind of view of what the roadmap is. Really importantly, it helps clarity on what not to do. The businesses we get involved in, we'll touch on a couple of case studies, they're getting traction with their clients. They're getting asked to do all kinds of different things. Could you do this custom build for me here? I really like this part of the product. Could you do that? And when you're in the early years, you think, yeah, they're going to pay me revenue. Brilliant. I'll do that, because you just want to scale. Actually, that can get you massively bent out of shape if you've got a number of other customers all asking for different things. So helping to be really clear on this is what we want to be famous for. It's these 2 products. It's these 2 additional services that go with that. And we're not going to get bent out of shape. You know, the confidence to say no is often quite important. Final part of that is sometimes there's real opportunities through M&A to accelerate growth as well. So actually, is that maybe part of the story? Is it an organic plan? Is there a really nice tangential product that you could add into the mix if you required it? Yeah, having an investor on board potentially gives you some firepower to do that. Second one's accelerating growth. A lot of the businesses we get involved in are heavily reliant on the founder team and their network and word of mouth kind of sales, which is great. Shows they've got that market position, they've got real traction. But how do you make that more scalable? How do you bring in some of the systems and processes that help you prove that this is a more scalable sales engine, sales machine, getting into some of the metrics we talked about, are you properly tracking what your different marketing channels do, what your different sales approaches do, how much does that cost to acquire a customer, etc. What do you want to be famous for, as I've talked about? How are you going to get that message out to market? Is it through partnerships? Is it through direct outreach? What are your account management processes around that? So when you've got these customers on board, you're trying to drive lifetime value. We help people put key account management processes in place to kind of go, look, what's the path here to upsell and cross-sell across this organization? How do you elongate life? How do you manage customer success, etc.? What are the product extensions? So, what do we think we could add to our technology roadmap that would help us to accelerate further sales growth? And often then it's really kind of refining ultimately what we think we're going to be selling to our next person, because we've opened up a new market, we've expanded our reach, we've got a sales team now that can be added to, we've got a methodology that makes it more systematic. By the time when we get involved, businesses are often on the journey on that, can point to some of those things, but sometimes need help kind of building out into something more scalable. So we spend a lot of time helping businesses with that. People and organization, huge one. This often starts with, I probably should have done it the other way around. What's the succession ready board? Basically when we start an investment, everybody's wearing too many hats. Everybody's doing things off the side of their desk, trying to be the finance person. And we're just talking about, say, the finance and the head of research and the head of content and the product development guy. Suddenly it's actually, if you bring in some functional expertise, new CFO, head of sales, ops, marketing, whatever it is, not to change the incumbent team, but to bolster and add to that, and to basically enable people to focus on whatever they can do, what's their area of expertise. It really helps scale the organization. And then thinking about how that filters down to the other people in the business, so you can empower them to be more scalable and efficient as well along the way. So the whole piece around organizational structure, how do you bring in new talent, how do you train them up in your ways of working, how do you scale that part of the organization? Obviously that's different depending on whether it's software or services, but absolutely vital to every investment that we do. And actually vital in terms of due diligence outside of the financial metrics, people kind of going, is there a positive culture here that we think we can scale if we want to buy the business, or we want to be the next investor to help us scale? That attaining the culture as the business scales is something we think heavily about communication and transparency and the right culture around the organization, and particularly when it's going through fast change that we've been talking about above. And a platform for success is the fourth area we talk about, and that's really to enable a lot of the things we talked about earlier. We've got the right systems and processes in place. The right finance systems? Have we got proper CRM and BI tools? Are we able to make decisions based on data now, rather than kind of some of the rule of thumb stuff that happens when you're in the early stages of growth? Really important for being able to show the proof points when it comes to the next transaction. And also to enable the larger team, the people that have been put in place to kind of all follow the same hymn sheet, as it were. And on the right hand side there, we also get involved in follow-on funding, extra capital for growth, and being able to have the right financial rigor and the right system and process obviously helps with all that side of things as well. And to the last part, data-driven KPIs to underpin the value story for the next buyer. So that's a mixture of helping build capability in the business, helping bring expertise from our side, helping leverage people from our network who've kind of been there and done it before, but ultimately trying to put plans in place at the outset to help prioritize which of those are going to give you the most uplift in value, but recognizing that businesses are on different periods of maturity on each one. I won't talk through all of these, but this is it in action ultimately. So CubeLogic is an enterprise SaaS business that's involved in credit risk management and compliance in the energy and commodities and financial services sector. We found a led team back in 2020, so it was a COVID deal, which was a joy to do remotely. The business was 7 million of revenue when we invested. We helped them scale to 23 million revenue just under 4 years. This was all about prioritization. So great market, increasing need for data to make better decisions when it came to market volatility, and ultimately trading organizations trying to navigate risk and make more profit. But legacy technology infrastructure, lack of usage of live data, increasing regulatory compliance. So this business was one, exactly as I mentioned before. When I first met them, they said they had 12 different products. And we kind of went, you don't have 12 different products, you've got 2 products that you built loads of different custom versions of for clients. So let's refine that into a clear roadmap. You have one product, credit risk, another product, compliance. How do we refine the platform and go to market with a single view of that? That involved everything from a full SaaS transition. So they were still partly selling perpetual license and partly doing SaaS. It involved a review of the pricing model to kind of recognize that, you could be a bit more sophisticated around, what you can charge for it versus competition. They were the market leader in credit risk, but we still had legacy pricing from about 5 years ago and still didn't have that confidence to now go, we've got some of the biggest names in the world using it and probably charge a bit more. And it involved thinking about the technology roadmap and how much we needed to invest in it to make it really scalable for some of the largest players in the industry. So actually, significant investment in the technology teams to help enable that technology transition. So that was the talent piece around where's the best capability here for the different aspects. We ended up setting up a hub specifically for data integrations, which was in Swansea, a real hub of kind of talent, and it was great. Berlin around some of the specifics around the energy market. The US team was about boots on the ground and go to market in the oil and gas space. So you can see there, each one of those were kind of big building blocks that goes back to what I said around the toolkit before. It was about international expansion, really investing in the go-to-market side. A key part was there was 2 founders at the start and a really good team of about 80 people. But we hired a COO, CFO, chief revenue officer, and a chair to kind of bolster that senior team, which was key to enabling them to grow at the rate that they did. And then all of that culminated in financial improvement, really. So ARR tripled, the professional services part of it, they were giving that away for free. Previously, we managed to get that to the point where people recognized it was expert, $1,500 a day. We made 43% gross profit on that at the end. And we were able to show, over Rule of 50 kind of growth or metrics, which meant we got a premium outcome ultimately. So this was the deal we exited last year. Very kind of premium outcome in terms of SaaS metrics because we were able to start with the end in mind and kind of build the story towards being able to demonstrate, those metrics that we've been talking about earlier. One more, just to show that it wasn't a one-off. So it's another one. This is an enterprise SaaS business focused on aviation safety and maintenance. Again, very similar approach. So had a proven position with a number of airlines. Weren't really making the most of the full opportunity. So this was about how you digitize aircraft maintenance and safety records. Once you've done that, what can you do in terms of the services that are operated in that environment? So if you've got all of your fleet digitized, you've got all of the safety and flight records coming onto a platform, what other services could we offer essentially? So ultimately compliance as a service offering where some of our people in the business were aviation engineers as well as software developers. We could review the platform live for customers and tell them that they were able to show regulators like the CIA, etc., that they had everything up to date, as opposed to historically having to go around and audit, warehouses full of paper records, basically. So we actually managed to double the license cost by giving that service alongside it without much more cost. This was all about building out a sales team, really. So it's an international market. It was already well known in a number of clients when we got involved, but they needed extra sales push outside of the founders. So boots on the ground in Australia, boots on the ground in the US, actually working alongside Qantas, actually embedding ourselves in their office there to kind of help with the technology roadmap and then selling to other Asia-Pac customers through that network. A lot of the systems and processes stuff was about bringing it all in-house. So this was the ultimate done off the edge of the desk, outsource all of that. We're all focused on sales and technology. But actually when you bring it in-house, you can start to have these conversations about the commercial model, pricing, etc. again, senior leadership evolution, brought in a chairman, brought in a CFO, brought in the ex-CIO of EasyJet as an advisory board member, hired a chief marketing officer, had sales talent, as I said, on the ground. And in this instance, whilst you don't often want to massively increase the cost base, we ended up doubling the size of the development and engineering teams. That was in India and across Asia Pac, mostly for that reason of we were able to kind of have this tech-enabled service alongside the software, basically. It's a different outcome. So should have said the previous one was a private equity-led process, sold to a larger investor. They went through all the rigor of due diligence around that. This was selling to a German trade buyer who sort of tapped us on the shoulder partway through the investment. So it was actually an off-market sort of process. Took quite a long time to get through their diligence, but ultimately it then became part of a wider group that got rolled out across that organisation. So another highly successful outcome, and again, being able to demonstrate all the metrics that we talked about.
You used to phrase again that off-market process. Can you just explain that?
Yeah, so in this example, so we thought we were pitching into it was Lufthansa Technik, they're one of the biggest aircraft maintenance businesses in the world. And we thought we were selling the software into their 60 base stations. So we started rolling it out. They got to know what the software was like, started to like it, and then they basically came to us and said they wanted to buy the business. They had a debate then about whether to run a wider process, but they were one of the obvious buyers for it. So we, I won't say chanced our arm, but we probably did, and said, look, here's our upside. When we did our original investment case, here was our upside number that we thought we might get at the end of a 5-year journey. We told him that was the price. CFO fell off his chair down the other side of the table. And then we spent the next 6 months repeatedly saying, that's the price, that's the price, that's the price. And in the end, they paid for it, basically. So bilateral deal off market. It was one of those other examples where they had not done any digital transformation. It was all very paper-based in their organisation. They needed to start the digital product, really, and so they were willing to pay not tomorrow's price today, 2.5 years back the line price today, basically. Debate we sometimes have. We get approached quite a lot along the way. Most times we'll run a wider process to sort of test the market, but in that instance, it made sense.
Anybody else got any questions to start with?
In the go-to-market, you mentioned partnerships on one of the slides. How hard can those be in terms of setting them up, getting people like chat, but actually getting them done? And then you said one of them you actually installed people. Was that in terms of?
We did, yeah.
Qantas maybe, was it?
It was Qantas on that one. We did it in CubeLogic actually as well. Comes up on every deal, and there's always this temptation to go, it's a great route to market, so let's go and set up partnerships.
They've already got
15 different people, they've already got these clients, etc., etc. We tend to kind of find that actually what's the real rationale, what's the real benefit for them to do it. There's no point to say, here's my partner page, I've got 15 different routes to market and not investing in it. So a lot of the time it's about what are the 2 or 3 really interesting relationships you can build where there's a real incentive for them to sort of push it out. So some businesses we get involved in, it's the major cloud vendors. So it's Microsoft or it's AWS or it's Google, because you can kind of use them as a route, particularly if it helps them with kind of consumption. And they've got well-established kind of partner channels, but then we tend to find you need to properly invest in it, hire a partner manager, really understand how it works internally, make connections with the right people to help play the game, ultimately, to get them to sell you in. In other instances, and this was a good one, we managed to get to the point where we were taking data feeds from different platforms, Fitch and S&P and people like that. And when we needed that because our customers wanted it, so we built the integrations, we're taking the feeds in, and then you start to realize, hang on a minute, there's a benefit to these data providers and us connecting all of this up and clients consuming the data. So we then decided to go the other way and go talk to them and say, we built this integration. Do you know that Shell, BP and Chevron and all these insurance players are using more of your service because of what we've done? Let's go to market together. So in that example, we went and talked to them about an integration, a more formal integration, and then leveraging their US network to help take us to market there. And we realized they really liked that because they were a data business that wanted more products. So actually then, they ultimately they could be a potential buyer for it later down the line. But we've had the temptation of kind of going, let's have 10 partners or 15. And it's actually about properly investing in the relationship and making sure it's a two-way thing would be nice.
So in those, you sort of establish some kind of working relationship before you actually.
Yeah. Can you work together? Is there any way of getting symbiotic relationship basically? So can you make it win-win? Otherwise,
Really get before you then sort of go up on the.
yeah, this is our experience. And otherwise, it becomes well, you might try and convince someone to resell your product, but probably got 20 other people having the same conversation. So
Yeah, and also that if you convince that person, they've got to sell it into the rest of the management.
exactly. Yeah.
In both examples, you talk about kind of upping the game in terms of systems and process, the seniority of the team, the capability of the team.
Yeah.
When I was on the sort of acquisition side of things, quite often we like the idea of actually bringing businesses onto our systems.
Yeah.
So how does the cost play out?
About data basically. So we tend to go, what are the right, I'm not saying let's go and put everybody on SAP or Oracle or anything like that. It's like what's appropriate for the businesses and scales, but how do you try and get the joined up view of the customer? So how do you try and get the right approach to CRM into whatever finance and operating system you want to use? And ultimately what version have you got in terms of delivery? So we think a lot about what's the customer journey from marketing through sales, through onboarding, through delivery, through invoicing, etc. Can you have a joined up kind of data approach to that? So
it's about it being joined up rather than being.
It's not about having the all singing all dancing ERP, but it's ultimately someone's going to want to diligence that all the way through. If you're running the business, you probably want to have a single view of the customer. So actually, what's the right solution? And what's happened over certainly the last few years is you can actually get quite a nice approach, and we tend to use similar finance systems, similar to the RM. Similar kind of tools around if there's a professional services element, professional services automation, that now the cloud hosted solutions that you can kind of API together, you get a kind of data warehouse underneath all that, you can actually get a pretty good view.
Okay, you answered my question. So
yeah,
so it's
for your
it can be a patchwork, but it's about getting end-to-end view over the data.
For your example, how can that trade buyer be confident that all the data you presented is solid, and if they do want to transition it, they can just extract it, basically. Yeah. Well, at least you can answer all the questions along the way. And as a management team running the business, you run it on data now. All the cohort analysis we were talking about earlier, the pricing, etc., etc. But it doesn't need. It's certainly not. Let's go and do a 2-year ERP project. Because that's questions also. Because that's questions also. I'll pass this.
Yeah, I think Barry's on call now. Okay.
Hi, Barry.
Yeah, we
Here he is. Yeah.
Hi, Richard.
Hi there. Welcome. Thanks for joining us.
No problem at all. And sorry, I can't be there in person, but I know we've got some people online as well. So it's great to meet you all. Okay, so yeah, I'm Barry Anns, and Richard and Charlie asked me to come along just to really talk about a sale process from a CEO's perspective. I was running a business in 2018, and we were looking to sell. It was actually a couple of different businesses within a group, and we were looking to sell. And I started working with Richard and Charlie then. We subsequently sold both the businesses at the end of 2019 and during 2020. We nearly managed to sell both of them around about the same time, but a small thing called a pandemic came along, and it kind of scuppered that slightly. But fortunately, the people that were going to buy the second business came back 6 months later. It didn't help that the CEO of that business had asthma, and he was a little bit worried when the pandemic came along. So in the end, we sold both businesses successfully. So it was a good outcome for the majority shareholder and the rest of the shareholders. But what I'm going to talk about today, really, I suppose, is some of the things that we wish we'd known when we set out to sell the business. And some of it's been covered today, I think, in what I've heard so far. But this might be just a little bit more specific from my perspective. So you're probably going to hear all the things I did wrong, as opposed to the things we did right. But we did get a good outcome. It's just that perhaps we could have got a better outcome, or perhaps we could have made life easier for ourselves if we'd just known a little bit more when we set out. So the first thing is the kind of due diligence part, really, and I suppose it's about trying to anticipate the types of questions that are going to arise, and making sure that we're storing the information so it can be flexibly presented and calculated. Ultimately, whatever you put forward as your model, an analyst is going to take, they're going to look at that information, they're going to want to analyze it in their own way. And if there are weaknesses in the business, and there'll probably be some, they're going to be found ultimately. So getting somebody to kind of cast their eyes over things, whether that's advisors or other people, in a fairly dispassionate way, is really important to try and sort of identify and address any sort of potential concerns early, so you can be really well prepared. And that kind of leads on really to something a bit more specific around data preparation and presentation. It has been sort of covered a little bit from what I've heard, but I think it's important to spend that time around being able to have data available so that it can be presented as flexibly as possible. With our software business, we could have been a lot better prepared in that sense, and been more prepared to provide the information in different formats. We kind of had a number of different things going on, from proper SaaS revenue, recurring revenue. We also had some license and support in our business as well. And we also had, from previous days, a kind of finance arrangement that we'd had with customers as well. So we kind of had a mixture of different types of revenue coming into the business. And ultimately, that all had to be presented in a way that a purchaser could imagine it, in terms of the way that business would ultimately run, perhaps over time. And we had to spend, at one point, I remember, trying to manage the buyer as we were rapidly in the background trying to represent data and take it out of systems and put it into spreadsheets and things. And it was a complete nightmare, and something we really should have anticipated that was going to happen. So I think whilst you might feel that questions sometimes that you'll get in from buyers are a little bit irrelevant, or you're not quite sure where they're going with it, ultimately, if they want to see that information in that way, you've got to be prepared to do it so that they can answer the questions that they want to answer and put together whatever model that they're putting together. The next thing was really around sufficient resourcing. So I can't emphasize enough how difficult it is to run a business and manage the due diligence process simultaneously. So I really recommend having a good think about, do you have enough people available to handle the workload? And what's your plan? Is your plan just simply to work overtime in order to be able to, facilitate what needs to happen? Have you got the right management team behind you, particularly in the finance area? You might have a great finance team, and they're producing the management accounts, and all the information that you want to see and all the KPIs that you need to see are all coming out really, really rapidly. But once you insert into that a sale process as well, actually it can really mess things up quite quickly, and you can get behind very quickly, not just with information then you're having to provide to potential buyers, but also then just with the information that you need in order to be able to run the business successfully as well. So having that right team in the mix, I think is really important, and we didn't get that quite right. Next thing really is around honesty and transparency. I'm sure this is a given for everybody, in terms of your moral standpoints and things, but I think the key thing is, don't try to hide any information. Make sure that everything you provide is accurate. There were times where it was tempting for us to perhaps, provide something in a slightly different way, not in a illegal or immoral way in anything, but just to present information in a slightly different way. And I think really, I suppose the point I wanted to make here is you'll only really trip yourself up later down the line. It might be 3 months after you provided that information, and actually if you start to lose credibility, which I found to be the sort of hidden currency of M&A, if you like, I suppose, constantly you're being tested on your credibility and, you know, are you genuine and is the information you're providing good, and is what you're saying is happening actually happening? Do you know what's going on in your business? All of that is really, really important. And that kind of takes me on to the M&A process. I think that kind of corporate development work that you need to do up front is a science. So again, you know, that kind of flexibility of data and the experience that goes on all the way through the process is really important. And there's also, I think, one of the things that I sort of thought would happen is that, you know, we get a bunch of offers, then we choose which one we wanted to go with, and then we'd sell the business, and it was all going to be that simple. But actually what I found, of course, as some of you know, is that, you know, as you go through that sales process, you might get a headline enterprise value that you're going to sell the business, or you think you're going to sell it. But then what happens is there's this process, probably of 3, maybe 6 months, that you go through of due diligence. And actually during that process, there's a bunch of what I would call mini negotiations, where actually all of the things that you said, you know, being tested, and you're constantly saying, well, you know, actually I thought this and you thought that, so actually I'm going to just chip away, and, or well, that means that this means that there's more risk here, or, you know, there's an issue there. And actually that whole process of kind of negotiation is, you know, happening right from that start. That's kind of almost like when the whistle gets blown at the start, when you've actually accepted, and then you might go through a process. Obviously there's lots of different ways this can happen, exclusivity, you know, and you can try and run the process if you're in a strong position, you know, in a much tighter way. But depending on the position you're in, you know, there might be lots of those sort of mini negotiations as you go through. Just a couple of other things. The next thing is really around maintaining the business's performance. So you'll write an IM, you'll show your business plan, you'll have a model, and you'll want that model and, you know, the business's performance obviously to be as strong as possible. So there's a temptation to exaggerate or set yourself very high targets. And then what happens is you might be in a process for the next 6 to 12 months. And all the way through that, your business shifts and changes and things go on, and market things happen and sales things happen, and unanticipated things happen. And actually maintaining your business's performance as you go through the process and actually doing what you said you would do is extremely important in order to keep that credibility. Any decline in the business's performance could affect the offer or the sentiment or the credibility around the sale. So that's just something to think about. And then lastly, the length of the process. You're not really going to be sure how long it's going to take. Again, if you're in a very strong position, you might be able to control that, but you'll never really know how long the process is going to take. So be prepared to dedicate a lot of time and energy to this. And personally, I'd recommend mentally preparing yourself, the key people that are going to be involved, and also friends and family for quite a challenging period. I've got a memory of, you know, being up. We sold our business to one of our businesses to an Australian company, so we were often up very late at night with advisors and lawyers. I remember on Christmas Eve going out for a meal with the family, being pulled away from the meal because I had to take a call because the deal was going to be signed, and I thought it was all fine, and then we ended up going off for hours and hours trying to work a final thing out because somebody got nervous about something at the last moment. But throughout that period, I had no idea quite how challenging it was going to be, and I wish I'd just prepared myself and friends and family a little bit more for what was a very challenging period. So that's just a few things from me. As I say, you know, both these businesses we sold back in sort of 2019, 2020. I've actually gone for another 5 years with one of the businesses that got sold with PE-backed buyers, and we've just sold the business again. So I've had a different experience there. But so that was my experience, and I hope it's of some use to everybody. And if there's any questions, I'd be happy to take them.
Sorry, Barry, thank you for your comments. I wonder if you could expand on your last point. When you did it with a board with PE members on it, did they do anything different in terms of how they ran the process that going back you would have implemented in your first deals?
Yeah, I think probably much more preparation. So I was, quite surprised at how much time and money was spent up front, I suppose, preparing the business for sale. The kind of bits that I was doing during due diligence in terms of putting stuff in the data room that I wish we'd prepared earlier, obviously being P-backed, they'd done this many times before, understood what was going to come up, and just prepared themselves much, much better. It didn't mean that necessarily nothing came up that they weren't anticipating during the process. But it did mean that they were much better prepared for it, I think, which I just think it's an experience thing. They understood that they were willing to invest in it as well.
Yeah, I think an interesting one, Barry, was of course you had a private owner, in peers, and we put the idea of vendor due diligence to peers, and that was never going to happen. Telling me you've got to spend X amount to get vendor DD to get the thing through. It's an investment. People have to be willing to make that investment in order to be able to get stuff ahead.
Yeah, I mean, we were quite constrained from a cash flow perspective and all that sort of stuff as well. So it wasn't the easiest business. I was effectively CEO of these businesses, and we had a majority owner who lived out the country. So I was managing that too. It's quite challenging setup from an owner manager perspective as well.
And just to pick up on another one of your points, you talked about having enough resources to run the deal. And I don't know, going around the table, if anybody has any kind of rules of thumb in terms of, do you need to plan another, 2 headcounts in your finance team for 6 months or whatever? Any rules of thumb to help guide people, the overcapacity you need to deal with all this?
We definitely think about almost CFO probably being involved in the deal process side, controlling the data, being involved in conversations with buyers or investors. So actually you need a really, really good financial controller / FD or whatever it is below to kind of go, look, you've got to be able to run that team day to day. Because bear in mind, some of that team might not even know about the process. So the BAU sort of side of it in the finance function needs to be able to run efficiently so that CFO is freed up for the more strategic aspects of the deal process, I suppose, particularly if you're doing vendor due diligence in advance, which we tend to, all of our exits will do that because we want to basically do the FDD process on our terms, I suppose, rather than having other bidders in the process. But it still means that CFO is going to be heavily involved in that, basically. So mostly about bolstering up the finance function, and then it's also thinking about who else is going to be involved with the bidders. In terms of the management presentation type meetings or putting the business plan together. So from our side, it's often about who's going to be able to cover for the CEO in that example. If the CEO is still involved in sales or client development or whatever it is, well, actually, what are we going to do from that perspective? Because they might not have the same capacity we've had before. So again, it's when we've talked about building out the sales function, some of those kind of key account management processes is, have they got people they can hand off things to? So they can focus on the bidders conversations as well, basically. Those are probably two of the main pinch points that we often see.
Okay, so assume your CFO is almost full time on that, so you can't have any big transformation projects going on at the same time.
Pretty much.
You assume a percentage of the key execs, so you want BAU to run at the same time.
Yeah, what we tend to do actually is, and interestingly, other people have seen it, but tend to almost go across the exec team. Are there some that are going to be more BAU and some that So let's say one we just did, we completed 2 weeks ago. CEO and CFO were pretty much full time on the process. CTO and head of chief commercial officer of BAU. And as you got more into the process, obviously the other two get into the process than the latter stages, but kind of carve it up like that. So that I absolutely agree with Barry's point around momentum, sales performance, delivery. Absolutely vital. No point doing all the preparation on BDD and putting business plans together and getting advisors if the business then falls off a cliff through a deal process. So that's how we did it on the recent deal.
Interesting. And so just to continue, so I hope I'm not monopolising things, but you talked about always doing VDD in advance of exits. With what kind of scope? Interest.
So on our, it depends who you sell into, but on ours we did financial, commercial, technology.
Commercial and technology, okay.
Yeah. Not even. We did it, but one, I've done 2 recently. One we did legal. The other one we did kind of didn't produce a legal DD report, but obviously full check of the data room. And we tend to try and keep the data room fresh from the previous deal. So our legal advisors would have been keeping up to date on that one. The last one we actually did a legal DD report, so we could minimise the amount of time that bidders were in the data reviewing their own work. But that seems to be less. But
I think what it says, it depends on the level of investment that's making different things up front. So if you've got an earlier stage business coming to you and they haven't got, the data easily to hand, etc., that's just going to take more time to sort of generate pieces. Quite often when we've got an entrepreneur coming into a sales situation, they haven't necessarily, the business might have grown like Billio, but the systems and processes and things aren't sitting behind it. So you've then got extra resource requirements there. And particularly, I think the legal stuff, if you look at something that's a bit more developed in terms of scale, and certainly if it's gone through private equity, they'll have the diligence report from when they come into the equation, and it will say this, and this need done on the that hasn't been done on the legal side, and then keep it up to date. So that tends to be what we see.
Yeah, on the finance one typically involves tax as well. So anything where there's a health check need of, look, let's just get our house in order around legal and tax issues, you do that. Do you keep that maintained?
Find that my experience of it is that it tends to be a completely different team that does the tax due diligence. So it ends up being a separate work stream.
Yeah, 100%.
Just to sort of pick up on a couple of those points. I said we sold 2 businesses. The first one, probably a lot of these experiences came from that. The second one, we'd actually done a big sort of transformation project on systems, and it was a telecoms and IT business. So there've been lots of sort of buy and build and more of a formula, I suppose, for selling those sorts of businesses. So we kind of knew the information that we need to provide, and having gone through that systems transformation, that was so much easier because we could say, they would say, oh, can we say it like this? You say, of course you can. Would you like to see this report? And, it was just much, much easier to be able to pull off information and present it in the way they wanted. Whereas the first one, the software business, we were actually in the midst of a transformation project with some of the systems, which was late, and we hadn't finished on time. And that's one of the reasons it got more difficult. And I'll just pick up on another of the points around the people that are inside the circle of trust, as it were. Obviously, if you get, if you've got people inside that, know that you're selling the business and they're supporting you, the people that aren't, if you suddenly realise you need their help because they're the only people that have got that information, or you suddenly need to bring them in and it takes time, and maybe they're concerned about it and they've got all sorts of other questions as well. So think carefully about that team as well, just picking up on a few of those points.
Thank you.
Okay, just one last point, if I may. So I noted your point about not hiding information. So from a lawyer's perspective, you can't hide information because not only could it potentially be fraud, but it's almost certainly going to be breach of contract when you get to the SPA if you don't then disclose. So if you then go and disclose something where you said the opposite, you are going to not look particularly credible. I know you mentioned that, but just to be interesting.
Yeah, and I mean, when it came to disclosure, and I started having to sign things to say this is all true, I warranty everything, come and get me if I've told any fibs or anything like that. It really, starts to put things into focus. And I suddenly went into, let's put everything in the data room. I want to disclose everything, because ultimately it might not fully protect me, but it's going to protect me more. After I've signed off all those warranties and things as a director of the business.
So one of the things that at the start you were like, oh, let's not sort of worry about that did come up.
Absolutely. I think trying to think of anything sort of specific in terms of skeletons in closets and stuff. I think probably there were probably areas of the business that were churning a bit faster than others. And I thought, that would be okay. Overall churn looks okay. It'll be all right. But, we've got a problem in this little market over here or something. And then actually they found it, immediately started asking lots of questions. I wasn't really well prepared and suddenly had to scramble and get lots of information together and justify where we were and, quickly turn it into a credible, okay, we understand that and we're managing it. And that was all on the fly, but we had to make it look like it wasn't.
And the sale message on your, when we're selling your business was the international expansion, right? So you kind of had to keep a sort of cohesive story going. If you don't mind me mentioning, Barry, or when we had yours, actually, I think there's a lovely tale in here. The deal would have happened, but on that Christmas day, but couldn't, because you had an FCA registration, didn't you? Do you remember? And it was like,
that's right. So we actually signed the paperwork, but we didn't complete, and we didn't think about that, Charlie, up front.
and I think I just want to use that as an example. So the business had this little FCA thing, and I remember asking the question, saying, "Oh, what's this thing you do here?" And the response back was, "Oh, don't worry about that. That's just a little something we do, right?" And a couple of times people asked questions, and we just gave, but actually it suddenly became a massive issue.
It was the lawyers that picked it up, as always the case. The people that are very thorough.
But actually, that had a big knock-on effect, because we did sign on Christmas morning, actually, because it was Australian time, wasn't it? And then there was a delay, and it was a unconditional signing, right? It was an absolute. Are you happy for me to tell this story, Barry?
Yeah, sure, go ahead. Yeah.
It was an unconditional signing, right? There's nothing they could do. All that had to happen was had to get FCA approval, and it would complete. You'd think that that's absolutely cast iron, isn't it? Well, what happened was there was a pandemic, and in mid-March we got a phone call from the buyers, and they went, "We're not going to complete, and you can sue us because we've got a pandemic. And we don't know what we're doing, and we're a private equity firm, and quite frankly, we're shitting ourselves." So actually, it all worked out really well. We agreed that they were going to complete. They said we will complete if we.
There was a slight change to the payment schedule, wasn't there?
Yeah, but in effect, they changed something that was absolutely cast iron, and that wouldn't have happened if we had got a better grip on I mean, I don't know. The revenue must have been 0.001% of your overall revenue. It was a tiny little thing. And by not being on top of that, it resulted in the deal not properly completing, which then meant that we moved into the shit happens box, because you never know what's coming around the corner. So
I think the problem is as well, whilst it was all cast iron, it was so sue us. And are you really going to go and do that in another country? It's just not going to happen. So you have to compromise, you have to negotiate.
But of course, got the FCA stuff sorted, we would never have ever had that conversation. It just would have completed. This is the point about timing and pressure on deals. You've got to keep deals moving, because you just don't know what's going to happen, right? Sorry, I've jumped in there. But, yeah.
Okay.
Good time for the lawyers, I think.
Saviours. Thanks, everyone.
Barry, anybody, I guess. I've got a question about how many full starts you've encountered. In my sort of career on the buying side of these things, I think I've done 6 or 7 times more due diligence processes than I've done acquisitions, and I wondered whether that actually holds true sort of on the smaller side of the business.
Yeah, we had I suppose we had a couple of full starts. There was a competitor, who would have been a trade sale, that was going to buy the business at one point in that process, and we didn't get too far with them. We were very careful about the information, but it was a false start. And then, as I mentioned earlier, one of the businesses was meant to sell around about the same time as the other business, but because of the pandemic, we ended up delaying that for 6 months. In the end, did exactly the same deal, but obviously just had to wait for a bit of slight nervousness to part before we could complete.
Yeah. Okay.
We're very we get inbound approaches all the time. Business to be invested in, to the point we talked about earlier. Sometimes you choose to engage in it, but often you're quite skeptical about whether they can actually deliver without that competitive tension, without being ready for a process. So sometimes we engage to kind of see if it's real, but then it might be actually this is more about warming them up for later down the line when we do it on our terms. There's quite a high chance of failure if you're not ready to kind of get into that debate. And frankly, if you haven't got any competitive tension, do we really want to see control over somebody who wants to have a look at your books, get into all the skin of it, and then might not deliver? So yeah, a lot of the time we're kind of thinking about, yes, okay, interesting, but come back in 12 when we're ready or the better conversation then.
Yeah, and to be fair, most of the times we walked away was because the seller wasn't really ready.
Yeah,
they thought they were ready.
Have you provided due diligence, sort of what you're saying you provide up front, what the business is, then generally it will complete. Having said that, we did have one last year, which which we did have a bidder who came in and did diligence, and actually we ended up selling to an Australian buyer who we had initially, because they were sort of slightly competitive, we'd initially gone, actually, we don't want to release a bunch of information to you, but we ended up doing it with the Australian buyer. But the previous buyer had gone away, and they had some PE backing, a USP fund backing them, and I think they hit some issues internally. So in theory, the team, the management team, had everybody's approval, and in practice, when something else cropped up in that business, it's what happens somewhere else in a different business. And that caused that one to fall over. So we had to go to the one.
So if I understand it correctly, you're saying investing in the vendor due diligence up front will reduce those.
Preparation in general, yeah.
Yeah.
Preparation in general.
Any sort of preparation, but the vendor due diligence, when you bring that in, and most businesses that can afford it, I would say, do go through some sort of vendor due diligence. And your point on scope is a good one. For a smaller business, you might go, right, actually, what I need to focus on is the accounting treatment of, you might not be accounting on an accruals basis, for example, and you get somebody to go in and go, yeah, this has been done right, and it's been done right historically, so I can see the trends. Yeah, that's quite a useful tip to have, because that's a real driver of value. To a full on scope due diligence that might include commercial, tax, and all the other aspects. But certainly, you're doing two things. You're making sure all the data's up, and you're in charge of the narrative.
How if often you're potentially talking to competitors or trade buyers, how much of a judgment do you make before engaging about sharing with them essentially all the business info?
So redacted information first. So they always ask for customer lists. You have to say no.
They always.
Yeah. So, and even we've got further down the line where we're almost been close to exclusivity, where they've been saying, show us your top 20 customers, and we're like, show us yours first, basically. And let's have that debate, because you need to watch out for people on a fishing trip, basically.
How often does that happen?
Quite a lot in terms of some processes. So actually it's about, have you built a relationship in advance of the process? These guys will say, sure, trade buyers take longer to get to the table, to have real sign off internally for it, to kind of be really keen. So you're trying to really build that comfort that they are probably going for it, and it is strategic before you start sharing sensitive information. Is often how we do it, and then it's almost get to the point where there's a valuation of bid, a structure, and it's subject to seeing X, Y, Z, and then you kind of then go, right, now we'll share it. Because
so at a minimum, they have to invest in a whole bunch of time, which actually is quite costly.
100%, and showing that you've almost, we often think about it reverse diligence, almost with the teams that we're working with, to go, look, have some conversations, joint workshops. Do you think there is a fit here? Are they talking to you about how they would integrate it? What would it work? How would it work?
So you make a judgment on that.
How credible they are, yeah. And then holding off anything sensitive.
And what about software? What about software due diligence? Do you third parties to?
We would typically in that scenario do some vendor due diligence to say, look, here's the setup, here's the infrastructure, here's how we built it, here's the languages, etc. But you're not getting access to any kind of code or information till, well, ever really. But you might want to kind of get into it later down the line and get more deeper demos with their technology people and stuff. But again, it's after you've committed to.
But after some commitment, you might do a screen share rather than actually give them access to anything.
Exactly. Yeah. Hold that right to the very end.
I want to keep it, as you mentioned earlier, it's a cultural thing. If you're going to drive some real synergy value out of a business, you actually need to think how they're going to fit together properly. So you introduce some of the parties and people talking to each other. You can certainly do that at an earlier stage than you pass out sort of your top 3 customers and what you're earning on them.
It can be quite incremental. So you might give them a list of the top 20, and you might therefore list the numbers but no names. But at some point, you might give them the names but not list them next to their number. And then right at the end on the last day, so you might say, like, here it is.
I was just going to say we went right to the last few days, but so we had like customer A, customer B, and things like that. But even with you know, they'd invested so much time and money by that point. I thought that this has got to happen now. Surely they wouldn't have gone all this way for it not to go ahead. So now you can have the list, because they wanted that comfort, you know, towards the end, that these customers actually exist and they are who they are and all that sort of stuff. But it was held back right to the end.
100%. You got to protect it.
So Vicky, are you going to chat us through the legal side of this?
Yes, yeah, I won't keep too long.
And maybe give an idea of the stuff you did on Chris's business that we sold together, because that was quite interesting. A due diligence process, given Chris had in-house counsel as well, right? So.
Yes, absolutely. Yes, we'll just talk a bit about the legal process and what you can do to, I know we've sort of touched on vendor DD quite a lot so far, the sort of things you can do to front end the process and be as prepared as you can, present a tidy, structured, well-organised business as far as you can to then preserve the value that you're going to get out of it. We've just got a brief slide about Clyde and Co for anyone who doesn't know us already. For the marketing bit, we've now got 60 plus offices around the world, 492 partners. We're pretty much full commercial service and insurance across some core sectors of insurance, transport, energy, and international trade. So that's just our marketing piece, and our core values, which I'll be obliged to include. They do work as one, excel with clients, celebrate difference, and act boldly. And certainly, I mean, I've been at Clyde for 14 years. Nick's been here for
25 years.
But we do, across the internationally and nationally, we do genuinely work all together. And we have the benefit of the sector experts in lots of different sectors. So it means that on the transactional side, we work with a variety of different experts all the time. And we've had, we've worked with Charlie and Richard on the Project Lotus, which was the ESG consultancy business, sale to a PE buyer. And we're currently working for an offshore trading client to bring in some small tech investments to kind of support their business. So that's kind of an example of where it crosses over the sectors and comes to us. So where our role, obviously, I would put it at the bottom. I'll probably start with that point first, but get us involved as early as possible. Nobody likes spending fees of lawyers, we know that, but it really is useful to get us in from the beginning, just because we can input on the negotiations from experience, but just to be aware and identify risks, talk about the process, help to front end as much as we can. Sometimes it's gone so far down the line that they come to us and say, look, we've agreed all the terms, everything's done, can you just draft the documents? And that's when the issues start coming to light. So yeah, at the outset, obviously you will be doing a lot with other advisors, particularly on the financial side, before you can come possibly to Polestar or others. But once it gets to the stage of putting information memorandum together, we probably help to input on that if we needed to, on the legal disclaimer or any verification exercise that needs doing, helping with NDAs if needed. Obviously, if there's particularly sensitive information, like I say, about showing that, inputting on that. We would also help set up the data room. So again, even if you're not releasing all the information at once, it's really good to have everything set up fully as early as you can. So even, but what it's often forgotten, I find, when the financial exercise is going on, the values all being put to the numbers, but actually the documentation to back all that is so important, and presenting that means that you're going to be able to make a much stronger commercial position, or keep a stronger commercial position. I think Rich said earlier, it's the fear of the unknown and the confidence of inventing, all those things. If you're presenting your business in a thorough, comprehensive, clear way, you're showing how well organised you are. That's obviously going to help keep that trust going. So what we would do in that process is we'd probably propose a structure for the data room. We've got an in-house provider that provides that. I think it's a small cost, but we can then administer that and help set it up, and provide as much support as needed in collating documents. With that comes the vendor DD, as I know we've talked about that a bit so far. You can do that at different levels. So sometimes it's just a case of we'll produce a standard DD questionnaire and provide it to you with an idea of, these are the questions that you're likely to be asked. So can we start answering these? Can we structure the data room in a way that matches that questionnaire so that when we present the information, the documents, we've already answered their questions. And we can then hopefully close off them asking too many in the future. Or you can do a full vendor DD exercise. But we said that involves a lot of time when you're all busy doing the day job, and upfront cost, but hopefully would pay off in the long run. It does throw up any potential issues that might come up that could need to be rectified or might lead to a price adjustment. So you can kind of anticipate all of that. But also if you're presenting something to the buyer that's already saying, look, we know about this risk. I think it's Barry was saying, we know about this risk. We've already thought about it. We've looked into it. You don't need to worry about it. This is how our business works. Charlie mentioned the deal and Project Lotus ESG deal that we did. We did a very, very thorough vendor DD exercise on that, I think it's fair to say. But yeah, they had an in-house counsel on it, pretty much full time, sorting out their contracts, collating everything, putting that together. I think it was probably several weeks, if not months, of that. But then it was really helpful to then present that, and that in turn accelerates the process when you come to negotiating the actual documents because you've got that mostly ready.
I think on that one, I mean, the sellers were doing comprehensive VDD sort of across all the streams. So, you know, they've grown from sort of 50 or 60 consultants to 250 in like 18 months or so. So the back office systems weren't up together. So when we went in, we actually introduced an FD into that situation to run the stuff internally and pull together some of the data, because looking at it, you know, we're going, people are going to diligence this area and this area, and therefore actually need to have that up and running, and then work with them around some pivoting of some of the software pieces so that it was so they had an ARR stream separate from the consultancy side. So they were they were definitely taking advice as they went along. And I won't say that at the time it got to due diligence, everything was absolutely perfect, but it was a lot further on, and it was at the right time in the market to go for it. So it is, thinking about where you're behind and putting the resource in to get you to the right place to go to market.
Yeah, and I think there was one. It wasn't a deal breaker. There was an issue that came up on the tax side, the tax legal side, that if we were dealing with all the due diligence at once, that would have probably escalated into a much bigger conversation, a much bigger negotiation point. As it was a kind of an unforeseen conversation that needed to be had, but everyone had the time and it got to the stage where they were comfortable with the diligence as a whole, that you could close it off a bit more quickly. And I'll talk a bit later about what the type of information that it's really important to get right, sort of as a priority from our legal perspective. So obviously then as the transaction progresses, we'll probably be involved in structuring the transaction, involved in the heads of terms. If there's an auction process, we'll be helping to manage that. And then obviously getting into the negotiating documentation, the share purchase agreement, investment agreement, shareholders agreement, if there's going to be one ongoing one, and any ongoing commercial and service contracts. I've also put warranty and indemnity insurance on here because this is increasingly appearing on every single deal we do. And it's quite important to know from the outset if that's something that you're going to require or request. For the cost, who's going to bear the premium? Setting up the policy, the DD also feeds into that because the insurers expect to see a pretty comprehensive set of reports. So going back to the scope of what you might ask for if you're going to have W&I, it's useful to have financial, tax, legal, commercial, as much as you can to present to them to say there's little risk here. And then the idea is that you cap the seller's liability at £1 or as low as you possibly can, and then the insurers will cover unknown risks. So again, to Barry's point, if it's the disclosure point is saying whether you have insurance or not, you can't hide things and expect to be covered for it. So, but it's another part of the process that can be quite time intensive. So getting ahead, getting that sorted early on, probably speaking to a broker before the process or at heads of terms stage, including at the heads of terms, is really helpful. So obviously, yes, then there's managing the process, lots of project management, hopefully going as smoothly as possible. So yeah, so in terms of what you can do to get prepared, pretty much every business we work with has untidy corporate records. So I put that to the top because it's the kind of thing people don't necessarily think about. Obviously, a lot of companies are very straightforward. They've had a simple shareholding structure, not a lot has gone on, it's just been incorporated and then traded since. But if anything has happened, that's it. It's just a really useful thing to get sorted, because especially if there's any legal aspect to it, any Companies Act issues, again, you want to get ahead, see if you can find any ways of resolving that early. IP licenses sounds really obvious, but again, sort of 6-7 times out of 10, there are issues with where the IP is sitting, issues with if there's a group of companies, the license is not being in the right place. We worked on a transaction last year for an insurer client who, we didn't act on the first bit of they'd acquired a claims handling business to bring that in-house, but they hadn't done any proper diligence on the software and the development of that software. So we then helped them to buy a separate company owned by a Dutch developer who had developed it. And even then discovered that company didn't actually have the right licenses, and he had other group companies that he was using, developers all over the place. So we just had a pretty comprehensive suite of assignment documents that we had to sort out for them. And then the platform that the software was developed on he was retaining that. So then we had a perpetual license from that back. It was a bit of a mess. That's the messiest thing I've done. And obviously acting on buy side, they really wanted the product, but they didn't have faith in it all being the right place. They were obviously going almost over the top in what they needed to ask for from them. The next point is any pre-completion restructuring or tax advice. Again, if there's anything that needs to be hived out, if you've got different product services within different group companies, is that all separated appropriately and in the right place? Or kind of equally, if you're selling a company, do you need to move anything into it to make sure the value is in the right place? We can also help with initial analysis on competition, National Security and Investment Act, third-party consent, so commercial. It comes out of the diligence, but again, it's a good thing to head off any change of control consents, any lender consents, anything like that. The NSIA is now in force, so it comes up. I think on the next slide I've put a list of the sectors it applies to. So if you're doing anything in any of those sectors, there's a mandatory notification, and that process can then take 3 to 6 months. So that all of those sorts of consents impact on timing, conditionality, and can be things that if you know about it from the outset, you can't think, right, we're going to do this in 6 weeks. Oh, suddenly we've decided we need this consent. Well populated, well organized data room we've talked about. We acted for the sellers of Pyramid Systems Limited, who had a securities finance platform, and they were so organized. It was probably unique in all of the deals that we've done, but it was impeccable. And it just meant that the rest of the negotiations just happened because they knew that the DD was happening methodically and properly, and there wasn't anything missed. And it just goes to the confidence and keeps the momentum going. Eventually, we've talked about, and then war stories. I think I've given a few. Nick, I don't know if you've got any other good examples.
I mean, if you ask me, okay, just on the IP thing, as you're going through that, it's totally there. I mean, no any time you find the IP is actually owned by an individual, and that's a disaster. Because it's not so bad if it's in the wrong corporation, you can get a cyber project. If you're going to someone who you've sacked, or who's left, or who's whatever, then you've got real trouble. So all that sort of preconditions stuff, finding out if you've got a problem there.
Or employment contracts that don't incorporate the assignments in that.
Yeah, we've had it with external contract developers, basically without the right agreement in place. They've worked on the code really in the early stages. Suddenly they're like, oh God, they might have been part of the system.
Yeah, you don't want them holding you to ransom for transferring what they've developed. So, I suppose it's be as prepared as you can be, appreciating what we've all said about the cost and the time that is. But it really, if you know that you're wanting to sell, be ready.
Just on the legal DD, you can do it incrementally. So there's a lot of the legal due diligence is genuinely quite boring and negative. It's there to say there's not a problem. So you check that the books are correct. Some of the DD on the deal side is quite interesting. It's when you ask to say, look at the longer term contracts, say, how long are they? Who's the customer? Is there a change of control? So the commercial people are actually quite interested in that. And it's often quite a small part of the report. So what you might do is actually just do that bit at the outset, because that's the interesting bit. And then as the thing is going forward, and you know you're going to do, but like go and do the rest of it now. That's one way of mentioning. We were actually doing a transaction last year, which in the end did a board. It wasn't really an auction sale. They got a whole bunch of buyers lined up, and they'd done all the other DD reports, they hadn't done the legal one. And then it just became apparent that it was quite a big business, and one of the subsidiaries did business in India, and it turned out they were doing business and had been doing for quite a long time in a sanctioned company. And so they just had to pull the whole thing. And they'll go back once they've sorted it out. It's not particularly difficult to sort out, but it just meant literally the whole process had to stop. And the seller had spent an enormous amount of money on it, on us and others, and it all just have to go again.
The other thing on vendor DD is I think if you are going to do it, you should do it to a helpful level. You know, I've done transactions where you're produced with a vendor DD report and it's not really worth the paper it's written on. So you just think I've just got to start from scratch anyway. So yeah, it doesn't give you much faith. And then if the lawyers have excluded everything from the scope of their review and just provided something very short form, not really that helpful. So this is I just put the list of the NSIA sectors. So if there's anything in transport's a bit more nuanced, but mostly if you're doing anything in those sectors, there will be a notification required.
Yeah, we had quite a lot of fun on Semco on this. We managed to persuade everybody it didn't fall under it, but it was quite hard work.
And it's also because it's such a new piece of legislation, nobody really knows how it's going to be, how transactions are going to be considered, how they're looking at them. So it's developing. I think it's probably, yeah, Charlie, you probably agree that if there's a competition aspect, it's a bit easier to get a steer from the competition experts on whether that's going to go through.
There was not a lot of confidence with any lawyers at all. Yeah, and of course when our buyer was a Swedish buyer, so he was like, well, what's going on here then? You know, why are we even having this conversation? You know, so it was quite interesting. It was the first time we've run into it. That was
we've actually found the process not as bad as you think though, actually. So we usually, as they say, 3 to 6 months, but we've had it in 30 days.
You did get it in 30 days.
Yeah, which is good. So they're getting the process is set up to run through it. It just means you can't do you have to do split exchange and completion, which is not ideal. Which starts another month of the process. But yeah, we did a bolt-on acquisition in the cybersecurity sector that we had to do it on. And we're now seeing it more broadly across tech services as well. Hopefully that's not a one-off that we got in 30 days.
I think it's not a one-off, but I think it is. I think you're right. But they just I think reserve their right that they can
start asking questions.
If we're doing a restructuring for a construction business, it's internal. It shouldn't, know that's going to go breeze through, but you still have to complete a 30-page form. I think that's it from us. Any more questions?
Does anybody online have any questions they would like to raise? Not sure how many we've got left online.
So no, I had a thank you from Tim and Graham who left. They've dropped me texts. I think we've got Kat on, but I imagine she's travelling. And then it's no, that's it. I think we've lost people online. We did say we'd go about this time, didn't we? So yeah.
Okay. Has anybody got any questions around the table? Anything people like to dig into, or we can adjourn and have some drinks and chat sort of on a more one-to-one basis? Whatever wants to. Anybody got any questions at the moment?
Just got one question on valuations. I mean, obviously ARR is key metrics, but what about the growth rate companies on? I just wonder how that you know, if you're comparing, say, a company sort of big ARR, but it's not growing especially quickly versus a small one that's growing faster. Just curious how those sort of things interplay when it comes to values.
Yeah, I mean that it fundamentally feeds in there. If you're growing like Topsy, then you know, because what people are looking at is what are they buying? They're buying the future profits and future cash flows of the business, right? So if you can give them confidence that the future cash flow of the business is going to be based on a revenue that's twice the number in 3 years' time, yeah, then like 20 times multiple doesn't look so bad, does it? Because you can get there pretty quickly. So yeah, it's all those are interlinked.
There's the famous rule of 40, which I know it seems to inflate into the rule of 50.
You got the right metrics.
Which is you add your ARR growth rate to your profit margin, EBITDA margin.
Yeah.
And you add those two together. If they're above 40 or now 50, then you're in the kind of highly valuable area.
Yeah. There's another metric that some of the B2C guys have looked at. They call it rule of X, but they put double weighting on the growth versus the profitability for earlier stage businesses. BC ecosystem. So that can end up being 70 or something, but it's going to give you double weight growth when you're earlier stage. And we think about it as kind of basically a rule of thumb. If you can kind of see 20-30% growth, that's pretty good. And then if you can get profitability alongside that, you know, that starts to show that you've got the right unit economics as well as the growth rate, and that's when you can start getting into the premium sort of end of the spectrum for us. That's kind of how we can think about it.
So it was ARR plus what?
Profit margin.
ARR growth rate plus EBITDA margin. So say you're making 10%, EBITDA that's 10, and if you're growing at 30% per annum, that's 40. So that's you're above the rule of 40.
So the business I mentioned, CubeLogic, we were everyone was talking about rule of 40, but we were doing 30% growth and 27% EBITDA margin. So we were saying we're doing better than rule of 50 in that example. And that's how we got people to lean into high metrics basically. Yeah. The other bit that we're doing and other people are doing is triangulating so ARR multiples and the range that the guys put on the screen, but also just trying to triangulate it back to what does that actually mean in sort of a multiple of profit for a more established kind of software business, basically trying to sense check that.
Just to go back to the logic behind that is that either your business is profitable, so it's worth money, or it's growing like hell and it's unprofitable, it's worth money. So, and acquirers kind of don't mind in some sense. So in your case, I don't know if the sense is your business is smaller, but maybe growing more. So that's fine. You don't have to be profitable if you're really growing well and your market TAM or your total accessible market is big enough so that a buyer can see, again, to my point, I can buy this and make it a money machine by investing in. So.
Yeah, the premium piece is we go into the cycle of with people going, we only value growth, but not knowing if the unit economics are right. Suddenly it's like, all right, that means multiple funding rounds, and that's where it will start to get a bit too frothy, right? Whereas now it's, can you get the growth rate there? Can you have some comfort that you've got some control of the unit economics? So therefore, in the teenage years, we call it, we kind of value the fact that you get the growth plus also a sensible profit margin that shows you've got a sustainable sort of business. And you can still choose to then go, actually, we're comfortable depressing the profit down to 10% or 5% or whatever, because we want to reinvest again. That's fine, because you know that the metrics are there, so you feel more confident placing it. I agree. You're always having this trade-off between growth and profitability, basically, deciding how much you want to place value on it, depending on where the business is.
One of the things we haven't discussed is timing of sale, and having had experiences where it's not always, hasn't always been right. The point I think is to sell when you don't need to. Because if you sell when you need to, if you take Barry's experience, take that and multiply it by 10 for our Wolf week, is the pressure, the timing pressure will hurt a lot. And that will ultimately probably defeat you.
That's the same for getting investment, right? You want to raise when you've got momentum, not when you're desperate for the money.
Totally, exactly.
Totally.
Certainly on exits, what you quite often find is people come looking to retire, yeah, and it sort of goes back a little bit to the sort of culture of the business point. They're coming in and they don't have any energy for the business and enthusiasm for the business, right. And the buyer can see that. So unless you've got your sort of second level management team championing the bit to take it on, which is fine, that's got a negative impact. So, you know, somebody's delayed too long in terms of actually exiting and then doesn't have the energy unless they've backfilled as well. That's to the
Well, and also they might want a workout period in Barry's case 5 years, was it? Or you're still there?
I mean, it probably was. As probably ours is a good example where we had an owner manager in his late 60s who wanted to exit, and the story was he doesn't need to exit. You know, he's quite happy going on for another few years, no problem at all. In reality, he was absolutely chomping at the bit to exit. But the reality, you know, we built enough of a management team, and you know, I was the example of, well, look, I can keep continuity if that's what you want. You know, I'm keen to remain involved if that's what you want. You know, and that's the way we kind of presented it, and it worked. But yeah, I think it's a really important point, you know, to you know, think about when you're exiting.
It's also the same on the investment on the way in. Yeah, so from our perspective, when we're meeting teams on the way in, we're kind of going, actually, people up for the journey here, have you got plans in place? Have you got that momentum? Because nobody wants to do a deal and 6 months later be sitting there going, that wasn't what we thought it was, or on the back foot, you know. So it's quite a lot about getting it when you've got the right runway, so you can ideally get off to a strong start, I think. And our best deals are where there's growth underpinned and you feel confident then to invest further, to drive it faster, as opposed to, oh, we said we were going to do this in the first 12 months, and then 6 months in, you're all going, hang on a minute, what's going on here? And everyone's a bit sort of feeling less.
And I think I was just going to say that, you know, you don't really, the trouble is, as a CEO, if you're running the business, you don't really know what your lot's going to be going forward either. You know, I was perfectly prepared that I would just get sacked day 2 as CEO, because that was the reality of what might happen. And I kind of needed to be open to that position, but also that I might need to continue as well, because the PE, in that case, it was an Australian business, PE backed. They needed somebody in the UK, you know, to continue to run the business because they didn't have anybody. So it was important to have a management team that could kind of give that continuity, particularly when we had a pandemic on our hands. In the recent one that has just happened, I might be out of a job in a few weeks. I mean, you just don't know what's going to happen ultimately, because there's a team of execs in the business just acquired us. So, you know, you just remain open and sensible to that situation, but you don't really know how it's going to end up. You can have your preferences, but obviously there's a lot of factors in terms of which deal you're going to accept.
On the time of the sale, so we acted it probably about 2 or 3 years ago now for this company, and it had a process. It involved the black soldier fly, and they, with the larvae, it turned it into I think animal feedstock. And they got all the IP and developed it quite well, and they've got a factory up and running doing this in South Africa.
Yeah, I know the company.
Yeah,
it's called Aggie Protein. Is it that one?
It was that one. Yeah, it changed to a different name by the time we got it.
They may have done.
And they've got some money in from a couple of high net worth individuals. They've done quite well. And the last valuation they had when they brought the money in was $250 million. But they never made any money. But they did have the IP, it did work, and they were trying to scale it up and had these grand ideas of putting these factories all over the world and whatever. But they just ran out of money, and they went bust.
No way.
Yeah, they lost every penny.
Oh, no
Yeah.
way.
And they were talking, they were going through a process, but they just started it too late. And in the end, they were talking to one party that was but this party was then drawing it out because they saw what happened. And I don't even think they bothered buying at the end. I think they'd just seen enough and decided no. But it was, you know, it worked. The thing worked. The product worked. But
Because they've not taken some kind of bridge.
They then started to look at every option. But they just run out of time.
Yeah.
You know, so timing does happen. I mean, yeah, we were acting on it. It was a really, you know, everyone was really excited about it. And they thought, like, we do this. Yeah, the last money came at 250. You get this in, do with it. Yeah, it's going to be $1 billion within, you know, years.
I mean, conscious of time and people may have other things to do. I'm sure a few people will still be around for a little bit afterwards. Happy to whatever chats people want to have. But in the meantime, thanks everyone for coming. Thank you to Clyde and Co for the use of the offices. And yeah, obviously happy to have a conversation on anything as and when it comes on.
Thank you very much.